Cost of capital will be the cost of study tonight. Here we are going to be taking a look at all the components of cost of capital. By introduction, what do we mean by cost of capital? This is the cost that is associated in raising a fund to carry out a capital project. And we are having a minimum return in which the investors and the providers of funds will be expecting at the end of the investment appraisal. So the minimum, which will be part of the cost of capital, that is cost of raising a fund, that the providers of funds and the investors will be expecting at the end of the investment appraisal. So we're having sources of funds and sources of finance, which are all having costs that are associated by raising this finance. So that will be covered under this cost of study today. So we are going to be looking at the cost of equity using both the dividend growth model and using the capital asset pricing model, cost of debt and cost of preference, as well as the weighted average cost of capital. From the definition, cost of capital, we said this is the cost of funds raised by company and used, and the return expected by investors that put funds into the company. And it is also the minimum return that a company ought to make on its own investment so as to be able to pay back their funds providers. In a layman definition or understanding of cost of capital, when there is a need to carry out a project or to invest in a project, so there will be a source of finance to fund such projects or investments. So the capital of funding that project will be associated with some cost, which is usually known as interest. And this interest will be capitalized to be part of the funds that will be raised to carry out these projects or financing a business. After the project execution, it is also expected that there will be a return, that is, there will be a profit, having settled both principal and the interest and any other cost that is associated with sourcing for this finance, and that is what is regarded as minimum return that the owners of the providers of funds will be expecting from the investment. Cost of capital is a required return that is necessary to make a capital budgeting project. And this is a cost, or it is a return that investors will require from their investment. Now let us move on to the calculation. When we are calculating or when we are required to calculate what will be the cost of investing or raising funds to carry out an investment appraisal on a particular project. This will be basically based on the two major sources of finance or two major sources of funding, which are equity and debt. The different sources of finance, we have equity and debt, have their different costs, while the average will be used to screen new investments with similar risks. So this is the full component that we are going to have a sub-component under each of the two major sources of finance, which is equity and debt. When we're talking about equity, this is a source of fund that is being raised by owners of the business and ordinary shareholders. So that's why we have the ordinary cost of fund and we have the equity, which is from the providers of funds. And the second one, which is debt. Once a business cannot be financed internally by the owners and the ordinary shareholders, there will be a need to look for additional funds to cater for a capital project or investments. So what the major part of the external source of fund is the debt aspect. And debt is also subdivided into major types of debt. So these are the two major sources of finance, and there are costs that is associated in sourcing for this fund. We move on. Looking at the significance or the importance, or we call it the advantages of cost of capital. It is used as a standard for evaluating investment decision as a cut-off or hurdle rate for screening investments. Why is it a measure as a standard of evaluating investment decision? Under the introduction to strategic financial management, we treated what is known as the role of a financial manager, which include three key roles. We have the investing, financing, and decision policy, which are the three key roles of a financial manager. So the financial manager will look for ways to source for finance that will be used to cater for capital projects, which is the investment aspect, after which the decision on how to distribute profit will now be made on the output on the investment decision that will have been taking place under the investment decision. So one of the most important significance of cost of capital, it is used as a standard for evaluating investment decision. And how do we use this to evaluate investment decision? Is having capitalized the cost that is associated in raising a fund to carry out the investment appraisal. And when there is an excess, which is the minimum return that the investors will be expecting after the capital project. So that will be a measure, a yardstick that will be used to measure in evaluating investment appraisal decision. So it will be used as a cutoff. And what are the cutoff? The company that is raising funds to carry out a project, we have their policy, which is their investment decision on the minimum return that will be expected on an investment. So the company can have a benchmark, a cutoff of 10%, 11 or 12%. So with this, the expected return will not be less than the cutoff. So if it is lesser than the cutoff, that means the project is not viable, and the cost that is associated in bringing out this investment decision is not viable to the users. It assists in determining a company's debt policy. This can also use as a yardstick or a measure to determine a company debt policy, how a company will be able to be managing their debts. And it also helps in appraising the performance of top management. This is one of the yardstick that will be used to measure the performance of a top management. So if top managements are underperforming, it is the cost of capital that will derive what it will be the performance. And if the performance has been a very good performance, based on the cutoff that the companies will have set as their policy of the minimum return that they will be expecting from an investment. And it also helps in choosing the most viable source of finance. It can either be through equity or through debt. And it helps in designing a good dividend policy. So these are the major significance of cost of capital. I hope we are together.
Yes, sir.
Okay. All right, let's move on to the components of cost of capital.
Yes, sir.
We have equity and we also have debt. The equity, which involves the ordinary shareholders, and we also have the cost, and we have the preference shareholders, and we also have the debt. And the debt can be classified into three. We have the redeemable, and convertible debt. And the last component, which is the weighted average cost of capital. This will measure the average of the two sources of finance or any other sources of finance, which can be sub under equity or debt. So the average between the equity and the debt sources of finance is what is known as the weighted average cost of capital. So we are going to be taking a look at each of these components. The first one, which is cost of equity. We said equity is a source of finance internally, and this can be through the owners of a business and their ordinary shareholders. And what is the cost of equity? Cost of equity is the minimum return that ordinary shareholders expect to receive from their investment. As the owner of a business and a shareholder in a particular business, we have the funds that will be contributed for the running of the business, and the expected return that each of these shareholders will be expected at the end of the investment appraisal is what is regarded as the cost of equity. So this is the minimum return that the ordinary shareholders expect to receive from their investments. And this can be measured in two ways. It's either with the use of the dividend valuation model or with the use of capital asset pricing model, CAPM. These are the two methods that can be used to determine So the first one, which is the dividend valuation model, we can use the dividend method to determine the cost of equity, that is the minimum return that the investors would be expected from their investment. And using the dividend valuation model, state that the current X market price, that is the current market price of a share, is a reflection of the expected future dividends on that share. And on this dividend valuation model, ordinary shareholders will be paid dividend after a project has been executed out of the total profits. And we use the dividend valuation model to determine what will be the expected return to the shareholders. And this can be determined with the use of this formula, is either with growth or without growth. The cost of equity using the dividend valuation model without growth is calculated as cost of equity, which is equal to your current dividend, DINO, divided by the market value of equity, X dividend. Or if it is a cost of equity with growth, that is, if there is growth in dividend, we make use of the cost of equity using the growth with growth. And the formula is as we have the KE equals to current dividend into bracket 1 plus G divided by market value of equity plus. Are we together, please?
Yes, sir. Yes, sir.
Yes, we are.
Yes.
We are, but you are too fast.
These people, they
Meeting is being recorded.
We can hear you now.
This meeting is being recorded.
So we can use these two ways to determine the cost of equity under the dividend valuation method. KE represents the cost of equity. D0 represents the current level of dividend, or we call it the current dividend.
Please, sorry for interruption. That is it 0 or O?
No. D no. O. Small o.
Okay, small O. Okay.
So we have the MV, which represents the market value of equity. And we have the G, which represents the estimated growth rate. That is when there is growth in dividend. Let's move on to illustration.
Mr. White, please, sorry to interject.
Okay.
Yeah, please, when your network had problem, there is an observation that you are a bit fast. Please, can you take it now at our pace, please?
Okay, all right.
Thank you very much.
You're welcome. Sample 1, ABC company has just paid a dividend of 35 kobo. The current share price is 3 naira 25 kobo. We are to calculate the cost of equity using the dividend valuation model. In this question, if you look at it very well and critically, out of these two methods under the dividend valuation model, what we can only use here is without growth. That is, the cost of equity will be your current dividend divided by the market value of equity. Please take note of this. The market value of equity that we are using will be X dividend, that is excluding dividend. So in a situation when we are given the market value of equity to be a cumulative of dividend, that means we need to go and deduct the current dividend from the cumulative market value of equity. That is one. Another means is that if we were given the market value of equity and we were told that the current dividend is yet to be paid. So when they give us this information that the current dividend is yet to be paid, that means we need to go and deduct the current dividend from the market value for us to get the market value of equity X dividend, that is excluding dividend. I hope we get that.
Yes, sir.
No.
Is
I
that
think
clear,
it
please?
yeah, no.
Okay, all right. The cost of equity is, let me bring in the solution page so that we can get this clearer. Under the formula, looking at the formula, cost of equity KE, please, can we see the screen now?
Yes.
Okay, we have D naught, that is your current dividend, divided by market value of equity. And what type of market value of equity are we talking about here? X dividend, that is excluding dividend. Most cases, examiner may give us market value of equity without giving us the information if it is X dividend or cum dividend. So we have two dividend. One is cum, we have two market value. One is cum dividend. cum dividend, and the other one is ex dividend. The cum dividend represents cumulative of dividend, that is cumulative in addition with dividend. While X is representing excluding dividend. These are the two types of market value that we usually have. But the one that we needed in determining our cost of equity is excluding dividend. So examiner will give us information relating to the market value, but it will not be stated if it is cumulative for dividend or excluding dividend. But how can we determine if it is cum dividend or ex dividend? Is by looking at the current dividend. If the current dividend has been paid, dividend has been paid. If the current dividend has been paid, that's market value. So therefore, the market value will represent the ex dividend. But if it has not been paid, that is, if the current dividend yet to be paid, so that represents that this will represent cum dividend. So and once it is a cum dividend, what we need to do to return it back to ex dividend is by deducting the current dividend from the market value for us to make it what? Market value ex dividend. I hope that is clear now. Hello.
The last statement. If it is cum dividends and you want to turn it back to market value.
If it is cum dividend, what you need to do is deducting your current dividend from your market value. That means the current dividend is yet to be paid. It is only when the current dividend is yet to be paid that you can deduct your current dividend from your market value to make it market value ex dividend. Is that clear?
Yeah.
All right. Let's move on. Now, we're given an example here that ABC company has just paid a dividend of 35 kobo, and the current share price is 3 naira 25 kobo. We are to calculate the cost of equity using the dividend valuation model. So are we using with growth or without growth here?
This should be without growth.
Without growth. Why? There is no growth in
There is no growth.
dividend.
Yeah.
All right. So sample 1. KE will be equals to D naught divided by market value. And what is our current dividend from that information given to us? The current dividend is what? 35 kobo. Why the share price is 3 naira 25 kobo?
25 kobo.
35 kobo is 0.35 divided by 3.25. Figure me what will be our cost of equity.
$10.7.
So this will be equals to 0.35 divided by 3.25. So we have 0.107. So that's our cost of equity. Let us move on. Sample 2. ABC company has just paid a dividend of 35 kobo, as we can see from that information, we were told that the dividend has been what? It has been paid. So the market value will not be what? It will not be altered, provided that the dividend has been paid. But if dividend is yet to be paid, that means we are going to deduct the current dividend from the market price so that we'll be able to get the market value after dividend has been paid. So we are told that the company has just paid a dividend of 35 kobo, and dividend paid has grown by 4% per year for the past 5 years. The current share price is 325 kobo. We are to calculate the cost of equity using the dividend valuation model. So what makes this question, this second sample, to be different from the first sample? That is what?
There is a dividend growth here of 4%.
All right, there is growth in dividend of 4%. So in calculating our cost of equity, we are going to make use of cost of equity with what? With growth here. That is sample 2. Cost of equity with growth will now be your current dividend, D naught, into bracket 1 plus G. G represents our growth rate, divided by the market value of equity. All these will be plus what? Will be plus our growth rate. Are we following? Are we there?
Yes.
All right.
Yes, sir.
The current dividend is 35 kobo. Growth rate is 4%, and the market value is 3.25 kobo. So we have 0.35 into brackets 1 plus 0.04. We close our brackets, divided by 3.25, and this will be plus growth 0.04. So here we are going to have 0.35 into bracket 1.04. 1 plus 0.04 will give us 1.04 divided by 3.25. All this will be plus what? 0.04. Can somebody figure us? .35 multiplied by 1.04. So your answer divided by 3.25, and the final answer will now be plus 0.04. What do we have, please?
0.33.28. That's the first one. Divided by 3.25.
Okay. Plus 0.04.
0.1424.
0.1424. All right. So approximately, or we said this is what? This is 14%. Are we together, please? Let us move on. We are still on the cost of equity using the dividend valuation method. Before we go too far, we're having 2 ways to determine our cost of equity. It's either with the use of dividend valuation model or capital asset pricing model. We are still on dividend valuation model, DVM. And the DVM, in calculating our cost of equity, it is either with growth or without growth. And we've illustrated with growth and without growth. But in a situation where growth will not be given to us specifically, like that of sample 2, that the growth in dividend has been given to be 4%, and we are in need of this growth to determine the cost of equity. So how do we derive the growth in dividend? Or how can we know, how can we determine if there will be a growth in dividend? So we can use these 2 methods to determine if there is growth in dividend or not. So there are 2 ways of estimating the likely growth rate of dividend. The first one is the extrapolating based on past dividend patterns. And this is also known as the formula method, using the formula, extrapolating formula. And the second formula is estimating growth using the earnings retention model, which is otherwise known as the Gordon's growth model. So these are the two ways in determining our growth in dividend. Information will lead us to which of these two methods can we use to determine growth in dividend if we are to make use of extrapolating based method, and if we are to make use of the estimating growth method, which is known as Gordon's growth model. It will be the information that will be provided that can lead us to which of these two methods we can use to determine the growth rate in dividend. Making use of the formula method, which is the past figure, historical figure from dividend, estimating dividend with past dividend patterns. This method assumes that the past pattern of dividend is a fair indicator of the future. And the formula for extrapolating growth can therefore be given as, we are going to have our G, which is equals to N square root of LD divided by BD minus 1. G represents the growth rate, where N represents the numbers of years of dividend growth. LD represents the latest dividend, or what is otherwise known as the current dividend. And we have the BD, which represents the base dividend, or what is known as historical dividend. So with this formula, we can determine the growth in dividend if we have all this information available. And what are the information? We need the numbers of years that the dividend growth rate will occur. We need the current dividend, and we also need the base dividend, which is also known as the historical dividend. So these are the information that we are in need of for us to make use of the formula method to
Sorry
determine.
for interrupting. So you are too
Okay.
fast too. You are too fast.
Okay.
Not just fast, he's too fast indeed. Because we can't write anything. Can't write anything. You're talking. We just be listening.
Okay. Let me minimize the rate at which the lecture is going. But hope we understand up to this level.
Since we can't write, I don't know whether we have opportunity of having this notes. We cannot write.
Having opportunity of what?
I hope this year, this lecture, the video and the audio together.
Yes, the video and audio will be shared immediately after the class.
Thank you.
But that doesn't mean I should just continue fasting with the lecture. Please, I will need everybody's audience.
Okay.
All right, please, let's continue. So using the extrapolating method, the formula is G equals to N square root of LD divided by BD minus 1. Are we there? So where your G represents the growth in dividend, N represent the numbers of years of dividend growth, LD represents the latest or current dividend, while BD represents the base dividend, or what is known as historical dividend. All this will be minus 1, and 1 is constant. Please take note of this. We may lay our hands on some other material, whereby we are going to see the formula that will be stating as N minus 1 before the square root of LD divided by BD. What we just need is understanding of how this formula is being used. So if you understand how the formula is being used, there won't be any need for us to be having that n minus 1 before the square root. Are we there? Are we following?
Yes, sir.
Okay. Now, I just mentioned something now that there are some textbook that will give us the formula to be n minus 1 before the square root. So the understanding aspect of this n minus 1 is that where your dividend is given in series of years, that is in numbers of years, year 1, year 2, year 3, year 4, year 5. So what you need there is numbers of years minus 1. Why do we minus 1? We can just use this particular illustration that we're having here to illustrate that. So when you're having the series of dividend as it was given like this, 2013, 2014, 2015, and 2016, there is a need to minus 1 out of this. What do we need here? The indication is that how many years can we have growth between the series of years that we are having dividend? Are we there? But if the dividend is not given in series of years as it is being given in this particular illustration, if it is given in form of numbers of years, that dividend for the past 3 years was so kobo. So there is no need of minusing 1 from that type of illustration. But if the dividend is given in numbers of years, year 1, 2, 3, 4, 5, that is where you need to minus 1 from your dividend. Now, let me illustrate that. Between year 2013 and year 2014, we're having dividend in 2013 to be 26, while dividend in 2014 to be 28.50. And the difference between 26 and 28.50 is what?
2.5.
What? 2.5. So
0.5.
how many growths do we have between 2013 and 2014?
1 growth.
One growth. That is 1. Between 2014 and 2015, how many growth do we have?
1 growth.
1 growth.
Making what?
2.
All right. Between 2015 and 2016, how many growth do we have?
1 growth.
of
Making what?
3 in all.
Making 3 in all. Now, between 2013 to 2016, we can only have growth in dividend how many times?
3 times.
3 times.
And that is the source of what? N minus 1. Is that clear?
Yes.
Means it's 3 minus 1, right?
4 minus 1.
4 minus 1.
4 years.
But, hello?
Yes, sir.
Hi.
All right. But if the dividend is not given in series of years, that is, if the dividend is given in this form, the dividend can be given in this form, whereby you are going to be having your current dividend to be a particular figure, and the historical dividend will also be given. If these 2 dividends that were given, with the examiner will state the historical dividend, that is the base dividend, how many years do we have this historical dividend? So in that form, they will tell us that the dividend for the past 8 years was or is. So if the type of information is given like that, the numbers of years given to us will just be used straightforward in that aspect. I believe you understand that. Do we get that?
Yes.
All right, now let's move on. Let's take a look at this sample. We want to calculate the growth in dividend. Laolu PLC has 10 million naira ordinary shares, 10 million 1 naira ordinary shares. Details of the company's dividend per share over the most recent 4 years are as follows. We have the years and we have the DPS, dividend per shares in kobo. 2013, we have 26, 2014, 28.5, 2015, we have 29, and 2016, we have 30. The current market price is 2 naira 35 kobo. A dividend of 30 kobo per share is expected to be paid shortly. Has this 30 kobo been paid?
No.
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 We were told that it is expected to be paid shortly. We are required to estimate the growth rate in dividend. B, what is the company cost of equity capital? Now let us look at this illustration. Before we move on to the solution, it is possible that examiner will not ask us to estimate the growth rate in dividend, and that is part of the information that I pass before moving on to how to determine growth in dividend. Examiner can just ask us directly that we should calculate the cost of equity capital. So in that aspect, examiner expects us to determine the growth before we determine the cost of equity. And how can we know if there is growth in dividend? When you are having historical dividend and the current dividend, that means there is element of growth in dividend. Are we there? Now we're having series of dividend. From here, what is our base dividend and what is our current dividend?
Base dividend is 26.
Okay.
Current dividend is 30.
Is 30. All right. So what is our N? What will represent our N here? What is
B.
N will be 3.
Oh,
3.
that will be 3. Thank you. So we've gotten all the information that we need to compute growth in dividend. Now let's go and determine the growth in dividend before calculating the cost of equity. I hope we are following. Sample 3. Sample 3. Laolu PLC. You want to determine estimation of growth in dividend. And the formula in determining our growth is what? G equals to N square root of base dividend, sorry, latest dividend, which is your current dividend, divided by the base dividend minus 1. Please, I will need every one of us to open our calculator and let us get this formula straightforward. LD, latest dividend, divided by BD minus 1. This is the formula. And from that information, growth will now be equals to, numbers of years is 3, right?
Yes.
Okay.
Why
Square root of, what is our latest dividend?
30.
30 is our latest dividend. Why base dividend is what?
26.
0.30 divided by 0.26 minus 1. Now we can just punch this directly from our calculator to get our growth rate. Are we together, please? All right, press 3. I just want every one of us to do this together so that we get it once without distracting. Press 3. Are we there? Have we done that?
Yes, we have.
All right. Press shift. I hope we are writing this step. You press the number first, then you press shift, press raise to power sign. Your raise to power sign looks like This is how your raised to power sign looks like. Can we see that?
Yes.
All right. The next thing, press 0.30 divided by 0.26.
Please, can you start that formula, that work again, I beg, please.
Okay.
Apart from the beginning.
All right.
Okay.
I can even write it here. Press 3.
I just not leave the
Then,
bar outside.
I didn't get that.
Go on, sir.
Then press shift. Are we following? Then press 0.30 divided by 0.26. So equals to, what do we have? Equals to what? Are we there?
Please come again. 1.049.
1.049. Now press minus 1. You have your final answer. You have 1.049. 1.049 minus 1 will now give you what? 0.049.
0.049.
Are we correct? Please, who did not get this so that we can
I
recap?
didn't get it too. I'm getting something.
I didn't
different.
get it.
All
Oh.
right. Okay. Okay. Are we there? Are we there?
No.
Press 3. Press 3. Number 3. Then press shift. Shift sign. Press shift. Press 3. Then press shift. Okay. After pressing shift, press raise to power sign. Your raise to power sign is, it looks like this. Have we seen that? You press raise to power sign. After that, press 0.30 divided by 0.26. Have we done that?
Yes, 5.347.
Direction.
1.049.
1.049. After pressing equals to sign, right? Then 1.049 minus 1, that will give you what?
0.049.
All right. I hope we all get this now.
My calculator says I don't know where that's the sign is in my calculator. What is the problem?
Editor. Say 3. Hold on. 3. Press shift sign. Then raise the power of raise to power. Then 0.30 divided by 0.26. After 0.30 slash divided by 0.26, are you going to press equal sign before you press minus 1?
Yes, you press equal sign.
Well, let me see. I need to get this thing right. 3.
I will need every one of us to get it right before we move on. Okay, another thing, maybe calculator differs.
Yes.
Okay. Another way, for those that are using the other calculator.
How do I get that
Are you
sign?
there? Hello.
Yes.
Okay. It's still the same. It's still the same function that we are going to press. After pressing your 3, you press 3, then you press shift. Are you there?
Yeah.
After pressing
Yes.
shift, you press raise to power sign. Once you press raise to power sign, your
It's
calculator will look
it's
like
showing 3
something that is
times.
having inverse. 3 what?
3 times square root. That's what it's showing.
Yes, that is what it shows.
Okay.
Then after that, you now press 0.30. Okay. Can you put your after that 3 raise to power sign, open brackets.
Open brackets.
Yes, open brackets. 0.30 divided by 0.26.
Open bracket. Okay. Zero
Have you seen
zero
that?
point 30
30 divided by 0.26.
Okay, yes, yes.
6.
Close your bracket.
Okay.
Yeah, I got it.
All right. Or click on enter. That is enter equal to.
1.049. Okay, yeah, I got it now.
All right.
Yeah,
I hope we are
better.
all on the same page
Haha,
now.
yeah. Hey, better. Ah,
Well done, Solomon.
thank you. uh, nice, yo.
Yeah, nice.
Finally.
God help us, sir.
So
Amen. Oh.
I hope we get it now.
Yeah,
Yes.
I got it
Yes.
now.
Okay. Now let us write the other calculator sign. How to determine this, so that whenever we are revising, we can also get the formula. So I will say or. You press, I think, let me even write it in a step format. Instead of writing it together, let me put it in a step format. Step 1, press the numbers. So e.g., in this case, our n is what? Is 3. So here we are pressing 3. The next step, step 2, you press shift. Step 3, press raise to power sign. The raise to power sign is something in this aspect. Then we have step 4.
Your voice is going down. Your voice is too low.
Is it clear enough now? Hello, can you hear me clearer now? Hello, please, can you hear me clearer now?
Yes.
Yes.
Yes, we can hear you.
Hello. Hello, can you hear me now?
Yes.
Yes, sir, we can hear you.
Yes, we can.
This
So the
meeting is
next
being
step,
recorded.
we press the numerator divided by denominator. Sorry, please, can somebody remind me? The number at the top is called what?
Numerator.
Point.
I'm right, right?
Yeah, numerator.
Numerator divided by denominator. denominator, or this is a two-way, open brackets before pressing numerator divided by denominator. Step 5. Press equal to sign. Then step 6. Press -1. I hope this is clear. Is this clear now?
Yes.
All right.
Very
So,
clear.
our growth is 0.049. Let's go back to the question. The examiner required of us to estimate the growth, which we have done now. And the B part asks us that what is the cost of equity capital? And the formula to be used here will be what? Cost of equity capital with growth, which is what? B. KE is equals to current dividend, open brackets, 1 plus growth rate, we close our brackets, divided by market value, X dividend. All these will now be plus the growth rate. Now, what is our market value X dividend? The current dividend given to us is 30 kobo. KE will now be equals to 0.30 into bracket 1.049. That is 1 plus 0.049. That gives us 1.049 divided by the market value of equity, X dividend. We were told that the dividend is yet to be paid. A dividend of what? 30 kobo per share is expected to be what? To be paid shortly out of the current market price of 2 naira 35 kobo. So this will now be divided by 2.35 minus what? 0.30 plus the growth rate of 0.049.
We are not seeing the screen again, oh, the calculation. The screen is not moving. It's not changing. Okay.
So KE will now be equals to 0.30 into bracket 1.049. We close our bracket, divided by 2.35 minus 0.30.
0.05, 2.04.
$2.05.
I didn't get that.
2.05.
Okay, 0.30 minus. Sorry, 2.35 minus 0.30. Sorry, 2.05. So plus growth 0.049. So what is the final answer here? Cost of equity will be what? KE will now be equal to
20.3.
0.314.
Did you get that? Hello.
$20.3.
20.3% internal control. Please let us confirm if that is correct. Now let us move on.
Don't move on yet.
Okay.
I've taken away the calculator. We are writing it now. I've taken it away.
Okay. Don't worry, this will also be saved. The Excel will be saved after the class.
No, please, sir. Let's take, because some of us will not have time to go through everything.
I'm not disputing that. It has been open for us to copy. 20.30. What does this mean? If we are interpreting, this means that the providers of funds are expecting return on this investment not to be less than 20.30. That is the implication. So if after the project appraisal and the cost of capital is being computed to be less than 20.30%, that means the project is not viable. And that can be as a result of incompetence of the management, top management, by not utilizing the funds appropriately, or by not increasing the revenue base, by not reducing the costs, which are the expenditure aspect of the project. So that is the indication if we are to interpret. Are we together, please?
Can you take that interpretation again?
Okay. So this means that the expected return by the shareholders is that the cost should not be less than, that is after the appraisal of the investment, the cost will be higher than 20.30. If it is less than 20.30, that means the project is not viable. And that can be due to the incompetency of the top management. And the incompetency can come in form of either not increasing the revenue base or not managing the costs, that is not managing the operating expenses properly. So the expected return from the investors should not be less than what? Should not be less than 20.30. That is the implication. Can we move on? Can we move on?
Yes, we can move on.
All right. We said we can determine our growth in two ways. It's either with the use of the formula method or making use of the Gordon's growth model. So we've just illustrated with the use of extrapolating based on past dividend pattern, which is the formula method. Now we are moving on to the Gordon's growth model. This model is based on the assumption that growth is primarily due to reinvestment of retained earnings. What does this mean? That is, this arises as a result of ordinary shareholders reinvesting their retained earnings instead of having it being distributed totally. So the retained earning will now be reinvested. So we can now make use of this to determine what will be the growth in dividend. And the formula is given below. Growth using the Gordon's growth model. Growth will be equals to R multiplied by B, where R represents the rate of return on equity. Return on equity, that is our R, where B represents earnings retention. And the rate of return or return on equity, or what is known as return on capital employed, will be calculated as follows. That will be your your earnings, or what is known as profit after tax, divided by opening shareholders funds, or divided by capital employed. Where your earnings retention will be calculated, which is your B, as follows. This represents your earnings minus dividend. And the dividend that you are deducting will be your current dividend divided by earnings. You get your B. So having determined your R and B, these two will now be multiplied for us to determine the growth rate in dividend. Let us take a look at this sample to illustrate using the Gordon's growth model. From the details provided below, we are to calculate the cost of capital separately using dividend growth model and Gordon's growth model. Can we see the requirement? The requirement states that we should calculate the cost of equity using what? Both the dividend growth model and using the Gordon's growth model. We have illustrated with the use of the dividend growth model, but let us still also confirm if we can still make use of that same dividend growth model before we illustrate that of Gordon's growth model. We have the numbers of ordinary shares of ₦1 each. In 1,000, we have 150 million naira. Market price per share, ex dividend, that is excluding dividend, ₦3.42. We have current earnings in total, that is total profit after tax. We have 62,858,000. We have current dividend in total, 6,158,000. Balance sheet value of net assets, 315 million. And we have dividend 5 years ago in total, 2,473,000. Now, if you want to calculate the cost of equity using the dividend valuation, dividend growth method, how do we determine our growth using the extrapolation method? That will be your what? N, square root of latest dividend divided by base dividend minus 1. Now, from this information provided, do we have our current dividend? Hello? Hello, are we there?
We can calculate it.
Yes, sir. We have it, but it's given in total.
It's given in total. So the
Total.
dividend given to us is in total, not per share. Are we there?
Yes, sir.
Yes.
All right. Do we have historical dividend?
Yes.
It is also given in what?
In total.
Total.
Total. But if you want to get it in per share, how can we do that to determine the dividend per share?
We divide it by the number of the shares.
The numbers of ordinary shares. Thank you. Now, with these two information, that means we can calculate. Now, if you want to calculate growth, we've gotten our current dividend, and we've also gotten our base dividend. What is the next thing we need in that formula?
N.
N.
Growth.
Do we have N?
Okay.
Yes,
Do we have N in this information?
Yes, we have like 5 years ago.
5 years ago.
We have 5 years ago. So that means what will be our N in this aspect?
5.
It should be 5 now.
That is 5. This is the second way that I said we can use to determine our N. But this instance, there is no need of minusing 1 from this 5. You make use of that 5 directly. But if your dividend is given in series of years, that is where you minus 1. Is that clear? So now let's go to our drawing board. So it's either of these two ways. if we are converting our dividend to par, that means it will align with market price per share that we're having as what? 3.42. But if we don't want to make use of our dividend per share, we can still make use of the total. But the only thing we also need to go and change to total will be what? Our market price.
Price per share.
Do we get that? So it's either of the two way. So since we've determined that the current dividend given to us is in total, so there is no problem in that. We also look at every other information. Are they also in total? If not, it's either we change orders to par or we change orders to what? To total. Is that taken?
Yes.
All right. Now let's illustrate. Dividend so we want to determine the cost of equity. KE will now be equals to, please always write your formula. This also attracts mark 1 plus G. You close your bracket, divided by what? Market value plus G. Please always write your formula. So now here, we don't have growth and we're having elements of growth. So we want to determine our growth. That will be N square root of what? Square root of latest dividend divided by what? Base dividend minus 1. So growth in this question will now be equals to, what is our N?
5.
5. Square root of what is our latest dividend?
Go to the question. Let's get to the question.
All right, I'm going to the question now. So the current dividend is given 6158, and the base dividend is given as 2473. 6158 divided by 2473. Is that correct? Minus 1. Now figure me. We've illustrated this before now, so this should not take us 5 seconds to determine. Figure 5 shift raised to power 6158 divided by 2473 equals to then minus 1 for those that are using the kind of calculator that I used when I was still writing the exam. And for those that are using the advanced calculator, you press 5, shift, raised to power sign, open your bracket, 6158 divided by 2473, close your bracket, enter. What is your answer? Then minus 1. Figure me.
That's 20%.
0.20. All right, thank you. Now, with this, we can calculate our cost of equity. What's our current dividend? 6,158. Don't forget, this is in total, into bracket 1.20, close your bracket, divided by what will now be our market value. $3.42 multiplied by numbers of ordinary shares, which is what? 150,000. 3.42 3.42 multiplied by 150,000. I hope we all understand why we multiply it by 150,000. Please, if you don't understand, ask question. We are here to correct ourselves. 0.20. Are we there? 6158 multiplied by 1.20. Then we have 3.42 multiplied by 150,000. So this plus 0.20. So here we are going to have 7389.6 divided by this. We have this value here plus 0.20. I hope you are also punching your calculator as I'm doing same here. Our KE will now be equals to this figure here plus 0.20. So we have 0.21, 21%. Please, do we have the same value?
Yes.
All right. This is about the extrapolation method. So the second method, which is Gordon's growth model. The Gordon's growth model says that your G is equals to what? R multiplied by B, where your R represents the return on capital employed, and your return on capital employed, ROCE, represented as what? Profit after tax divided by capital employed. And we have B, which is your earnings retention. And your earnings retention is your earnings minus dividend divided by earnings. Divided by earnings. Are we together, please? What's our earnings from this question?
It's 62858.
All right. Current earnings in total 62858. And what is our capital employed?
Balance sheet 315.
315,000. Okay, so let us determine our R first. That is 62858. 62858 divided by 315,000. So this will be equals to this value here divided by 315,000. Why your B, earnings retention? We have your earnings. What's our current earnings? Which is also the same thing as your profit after tax. 62858 minus dividend. What's our current dividend? We have 6158. 6158 divided by earnings. 62858. Figure me, what will be our B?
$0.902.
902. So we've gotten our R, we've gotten our B. So growth will now be equals to what? R times B. R is what? 0.1999549 multiplied by what? Multiplied by 0.902. Growth will now be equals to this figure here multiplied by growth will now be equals to this figure here multiplied by this other figure. We have 0.17.
Please, sorry, this B here, 62,858, is it minus 6,158? Is it all divided? I don't understand. How do you arrive at this 0.902?
Okay, it is 62,858 minus 6,158. Your answer divided by 62,858. What do we have? What do we have? Please, can somebody reconfirm that?
See, this
Correct.
This one has a trouble to understand.
It is correct. The answer is correct.
Please, do you get that?
Not yet, so please, you can just stick it again.
Okay, let us do it this way. So this will now be equals to 62,858 minus 6,158. What do you have? We have 56,700, right? Now that 56,700 divided by 62,858. So that is what we did here. So this will now be equals to this your figure divided by this figure here. That is correct, 0.902. Do you get that now?
Okay.
Correct.
Your earnings
The
minus
CE,
dividends.
sorry, in that formula for R, profit
Yes.
after tax all over CE, the CE.
I can't hear you again, no. Please, others, can you hear me?
We can hear you.
We can hear you.
Yes,
But
we can.
I can't get the person that is asking the question. I can't hear him clearly.
Yeah, I guess his network is a bit a problem.
Okay. All right, I think I get part of his question. The question is R is equals to PAT divided by profit after tax divided by CE. Your CE represents your capital employed. Is that clear?
His network is still not stable.
Yeah, I'm fine now. You said PE is capital employed now.
Okay.
I think I'm fine now.
So now, since we've gotten our growth, what we need is cost of equity. Our cost of equity, the only difference here is the growth rate that we have determined. Cost of equity will be your current dividend, which is 6,158 into bracket. Approximately, our growth here is what? Our growth here is 18%. We said or 18%. Into bracket 1.18. We close our bracket divided by market value, that is 3.42 multiplied by 150,000. All this will now be what? Plus growth 0.18. Figure me. Are we there? Hello? Hello, are we there?
Can hear you.
Okay, so what's the cost of equity?
Sorry, I got 0.19.
Okay.
19.4.
19.4. 19.4 percentage. All right, let us move on.
Yeah, correct. 19. 0 point.
Before we continue, let me just take a recap. We are still under cost of equity. All what we just did now is on dividend valuation model. And we said we can calculate cost of equity using DVM or capital asset pricing model. So we just completed the dividend valuation model. We are moving on to the capital asset pricing model now. The CAPM derives a required return for investors.
Thank God I get my calculator. This calculator is just
By relating return to the level of systematic risk faced by an investors. Note that the CAPM is based on the assumption that all investors are well diversified. So only systematic risk is relevant. What does CAPM try to portray? The CAPM is related to the return on capital from investments, taking into consideration the level of risks that are associated to investment. Hello, you having a question?
The last listing was 0.19. Do we need to convert it to percentage?
0.19, yes, that is 19%.
Okay.
All right. So the CAPM is the other method that we can use to determine our cost of equity. And determining our cost of equity using the CAPM is trying to identify the risks that are associated to different business, being that risks are differ depending on the nature of the business. The risk that is involved in automobile business is totally different from the risk that will be associated to service provider. And that is part of what the capital asset pricing model is trying to identify by focusing on the risk that is associated to a specific business. And this will be treated further in our next discussion, and that will be treated under the portfolio theory and capital asset pricing model. But let's take a look at the introductory aspect of the CAPM in determining our cost of equity. So the CAPM formula is derived as KE, which is equals to RF plus BI into bracket RM minus RF. The RF represents the risk-free rate of return, or it is also known as the government bond, or we call it government yield. We call it government yield. That is the risk-free rate of return. B represents the beta factor. And we have the RM, which represents the return on the market. And lastly, we have RM minus RF. The RM minus RF is representing the risk premium. So looking at this formula, let us take a look at the broadly explanation on this capital asset pricing model. Are we there? RF represents the risk-free rates of return. We have the B, which represents the beta factor. We have the RM, which represents the return.
So is that B? Oh, is it normal B? Or
Yes,
how does
you
it?
can just use number B. It's just a symbol. It is a symbol. So if you use normal B, there is no problem in using that.
Okay.
Return on the market. And lastly, we have RM minus RF. So this represents the risk premium. This represents the risk premium. So in a situation where examiner give us risk premium, looking at this formula, your RM minus RF, if your risk premium is given, this will cater for RM minus RF. But in a situation whereby examiner gave us RM separately and also give us what? Risk premium. If you calculate properly, we still arrive at the same figure. That means if you look at RM value and the risk-free rate of return, if we less the risk-free rate of return from the return on the market, which will still give us the same risk premium if examiner give us risk premium separately and give us return on the market. But most cases,
Your voice is faint. Your voice is faint. We can't hear you well. I don't know whether I'm the only one. Yeah.
hello, others, can you hear me clearly?
It's now we're hearing you.
So
The voice actually was faint then.
Whereby examiner did not give us return on the market, RM, risk premium will be provided. But a situation where examiner give us return on the market, RM, and also give us risk premium, we can decide to make use of either RM minus RF, or we make use of risk premium directly. But always state your assumption where examiner give you multiple information that can still lead to the same computation. So you can state your assumption that using the risk premium to determine the cost of equity, risk premium of any percentage that will be given to us. But if risk premium is not given and you are given return on the market, you can just make use of your RM, then you less your risk rate of return for it to determine your cost of equity. Are we following?
Take it again though. Let's go over it once more.
Okay.
Before solving question. So
All right.
can you go over it once more? Can you go over the formula once more before
Okay.
solving the exercises?
Okay. We have the risk-free rate of, and the formula is KE, which is equals to RF. RF is represented as the risk-free rate of return. We have the B, which is the beta factor. Beta factor is another topic on its own. When we reach
the voice is faint. Oh, hey God, the voice is faint.
Hello.
Okay, we can hear you now. Hey. The voice is off and on. It goes low, it comes up.
Hello, please, I believe you can all hear me.
Yeah, we can hear you. Go ahead.
All right. We have the B, which represents the beta factor, and we have the RM, which represents the return on the market. And lastly, we have the risk premium. And I stated earlier that risk premium can replace your RM minus RF. Most times, it's either examiner give us risk premium and ignore return on the market, At times, examiner can also give us return on the market as well as risk premium. But our determination will be the computation of cost of equity using the CAPM. So we can make use of either the RM minus RF directly as risk premium, or we split it by making use of the return on the market separately and lessen our risk-free rate of return. But any of the two that we are using, we should state assumption that will be in a situation where examiner give us all information, including the return on the market and the risk-free rate of return. But most times, it's either examiner give us return on the market without giving us risk premium, or examiner will give us risk premium without giving us return on the market. Is that clear? Can we move on?
It's clear.
All right. Illustration using the CAPM to calculate cost of equity. Company A has a beta of 1.2. Government bonds are currently trading at 4%. The average return that investors in the market can expect is 15%. Calculate the cost of equity using the CAPM. Now, looking at this information, the formula is KE, which is equals to risk-free rate of return plus beta into bracket return on the market minus risk-free rate of return. Now, from this information here, what is our risk-free rate
Your
of
board is not
return?
showing, no.
It's 4. It's 4%.
Is 4%.
Yes.
Okay. Why is it 4%? Your risk-free rate of return is also the same thing as your government bond. And why is it risk-free rate of return? Most government bonds are less what? Risks. So the risks involved will not be associated. So it's either we have risk-free rate of return or we have government bond. So this represents your risk-free rate of return. The beta is given to be what?
We are not seeing your board, though.
Please, who else is not seeing the board?
It's clear.
Who else is not seeing the board?
We can only see
Can
the
we all see
question.
the board?
We can only see the questions. We cannot see the main Excel of whatever.
Yes, we are still on the question. We have not moved on to the solution. Please, can we all see the question page?
Yes.
Okay. I'm only extracting information that we are going to use for the computation. So after we have identified the question, before we move on to the solution, please, can we all see the question page?
Yes.
Yes, yes.
Okay, okay. Now, we've said our risk-free rate of return is what? Is 4%. And beta is given to be what?
1.2.
1.2. What is the return on the market?
Return on the market is 15%.
Is 15%. So with this information, we can calculate our cost of equity using the CAP. Example 1. KE is equals to risk-free rate of return plus beta into brackets return on the market minus risk-free rate of return. Are we there? So KE will now be equals to risk-free rate of return is 4%. plus beta. What is our beta from that question?
1.2.
1.2. And return on the market is what? Is 15%.
Yes.
1.2 into bracket 15 minus 4. We close our brackets. Cost of equity here will now be equal to what? Please, let us take note of this again. When we are computing the cost of equity using the CAPM, so we follow broad mass. So if you are computing 4, before you add your 4 to 1.2, that means we need to determine our risk-free rate, our beta, and the risk premium before we add 4. Are we there? So this will now be 15 minus 4 multiplied by 1.2 plus 4. What is our cost of equity?
Lie. I will go.
Hello?
17.2.
I didn't get that.
17.2.
17.2%. And please, if you check what we did just now, I used 4, and the question gave us in percentage. So it's either we use everything in percentage, though we are still going to arrive at the same answer. We are told that the government bond are currently trading at what? 4%. The return on the market is what? Is 15%. So if we use it directly like that, that means all the information that we are going to be using must be in the same line. And your final answer will be stated as what? As percentage. Please, let's take note of that. So that we will not use 0.04. And when we get to the return on the market, we now make use of 15 minus 4. We will get the answer wrongly. So if you are using in percentage, use in percentage all through. If you want to use the number directly, use in numbers all through. Then after your computation, you now convert it to what? So percentage. Are we there?
Yeah.
Yes.
Okay. All right. Sample 2. Sample 2. Company A has a beta of 1.2. Company B has a beta of 1. Government bonds are currently trading at 5%. The average return that investors in the market can expect is 12%. Calculate the cost of equity using CAPM for each company. So what is the difference between these two companies? We have company A and company B. The only difference between these two companies is what?
Beta value.
The beta value. Beta value in company A is 1.2, while beta value in company B is what?
1.
In 1 is 1. So their risk-free rate of return is the same. Average return on the market is also what? It's also the same. So we can use this to determine what will be the cost of equity. Sample 2. Sample 2. We have company A and we have company B. Company A, risk-free rate of return is 5%, while return on the market is 12%. 5 plus beta 1.2, open bracket, 12 minus 5. Why that of company B? We have 5 plus 1 into bracket 12 minus 5. Figure me. I didn't get that.
13.4. Oh.
Then company B.
$12.
12%. Let's move on. Sample 3. Company A has a beta of 1.3. Company B has a beta of 1.2. Government bonds are currently trading at 5%. The average market risk premium is 6%. Calculate the cost of equity. Now, what happened here?
We don't have the RM. What we have is risk premium, which stands
We are
for
having the
RM minus RM.
risk premium. And this risk premium represents your RM minus RF. So beta is 1.3, 1.2. Risk rate of return is 5%. So let's calculate the cost of equity. Sample 3. Company A. Beta is 5%. Sorry, risk rate of return is 5%. 5%. Beta 1.3 plus 1.3, and risk premium is what? 6%. For company B, we have 5 plus, what is the beta for company B? We have 1.2. Risk premium 6. So what is our cost of equity for company A? And what's our cost of equity?
12.8.
Company B?
12.2.
Now, all what we just did now make us to complete all information that is required of us under the equity. We move on to the debt. In relation to cost of capital, there are 3 major types of debts. We have the irredeemable debts, we have the redeemable debts, and we have the convertible debts. Are we following?
Yes.
All right. The cost of irredeemable debt or perpetual debt is that debt which is not required to be repaid during the lifetime of the company. While the cost of redeemable debts are those which will be repaid to the suppliers of debt after a specified period of time. And we have convertible debt. The convertible bonds give the holder the option to convert or exchange their debt to a shares in the issuing company. The cost of irredeemable debt is determined as interest net of tax divided by market value of dividend, a market value of debt, where your I represents your interest rates, C represents the tax rates, and MVD represent the market value of debt. Let's look at illustration. A company has issued 10% with irredeemable debt. The market value of the debt is 90 naira. The tax rate is 30%. Calculate the cost of debt. That will just be your interest net of tax divided by market value of of dividend. What is our interest rate on this debt?
30.
10%. And the tax rate is given to be 30%, while the market value of the debt is 90 naira. So let's calculate the cost of the debt.
So yeah, just too fast too. Too fast.
Hello?
So yeah, too fast too.
Where exactly, please?
No, sometimes by taking down, no, when you're too fast like that, we can't even summarize simple notes. That is the issue. We'll only be listening.
Okay. All right, please, I'll be a bit slower. Illustration. A company has issued 10% irredeemable debt. The market value of the debt is 90 naira. The tax rate is 30%. Calculate the cost of debt. What is the rate of interest in this debt?
%.
10%. And the tax rate is given to be what?
30%.
Why the market value of the debt is given to be what?
90 naira.
Are we clear now? Can we stop now?
Yeah, we can go ahead.
So you need to explain the formula. The KD is the cost of debt, right?
Yes.
Okay.
KD represents the cost of debt. I
T is the tax rate.
The interest. T is the corporation tax rate. While MVD is the market value of debt. Is that clear?
MVD, market value of debts. Okay. Yeah.
So we have interest, net of tax, divided by market value of debt. Interest is given to be 10%. Tax rate is 1 minus 0.30. We close our brackets, divided by 90. Figure me. So this will now be equals to 0.10 multiplied by 1 minus 0.3. What do we have? Figure me, are we there?
Uh, 7.77 there.
Yeah, it's giving me
7 point what?
7.777777.
Please, I didn't get that clearly.
Let that the Togo and rest 94.
1 minus 0.30. That gives us 0.7. Then 0.7 multiplied by 0.1. 0.10 multiplied by 0.7. So that gives us 0.07.
Yeah.
Divided by 90. So what is the value here? So this will now be equals to 0.07 divided by 90. So the cost is what? 0.000778. That is the cost. Let us move on.
Sorry, sir.
Okay.
Our major concern is that when we
Can this be converted to percentage?
we'll be giving us
Yes, it can be converted to percentage.
Okay.
So if you are converting it to
7.7.
percentage, this will be what? Equals to the value here multiplied by what? 100. That is 0.07 percentage.
Oh,
Is that clear? Hello, do we get that?
Yes.
Now we move on to redeemable debt. When we are calculating cost of redeemable debt, the cost of redeemable debt is also the same thing as your internal rate of return. In determining your cost of redeemable debt, what we are looking at is the internal rate of return, IRR. And how do we determine the internal rate of return? The formula of internal rate of return is IRR. Let me write it here as cost of redeemable debt. Is also the same thing as your what? Internal rate of return. And your internal rate of return is equals to, we have the LR, lower rates, plus we have NPV, lower rates, divided by MPV, lower
so
rates,
this formula
minus MPV, higher rates, multiplied by higher rates minus lower rates. Is this taken? Where IRR represents the internal rates of return, LR represents lower rates. Are we following?
is it lower rate plus? The formula is not clear.
Hold on, you will understand the formula. Hold on, please. HR represents the higher rates. We have MPVLR represents the MPV with lower rates, and we have MPVHR that represents MPV with higher rates. This is the full information on the internal rate of return. Now, if we want to understand this formula clearly, or if we want to make use of this formula, we need information that is in form of years, details, cash flow, discount factor, first assumption, because this is a try and error. We have PV, and we also have the second discount factor, and we have the second PV. This is the information that will be needed to determine the internal rates of return. Now, let me go back to the formula. The formula states that IRR is equals to LR, and our LR represents the lower rate because we are going to assume two discount factors. One will be higher another one will be lower. So this LR will represent the lower rate out of the two discount factor that we are going to use. HR will represent the higher rate, which is the same thing as the rate that will be higher among the two discount factor that we are going to assume, because it is an assumption. We have MPVLR that represents the MPV with lower rate. That is, out of these two discount factor, we are going to have our present value, and we are going to use that to determine our net present value. So between the first discount factor and the second discount factor, we are going to have MPV for these two discount factor. So the discount factor for the lower rates is represented as MPVLR divided by MPVLR, which is your net present value with lower rates, minus net present value with higher rate. This will now be multiplied by your higher rate minus lower rate. Any question before we move on? Any question before we move on?
No.
Okay, let us illustrate. I think that illustration will give us a clearer and full picture of this formula. Let's go on. Redeemable debt illustration. A company has issued debt which is redeemable in 5 years' time. Interest is payable at 8%. The current market value of the debt is 102 naira. Ignore taxation. So we were told to ignore taxation in this information. Tax is not given. So that means our interest will be exclusion of tax. Now, the debt is to be redeemed in 5 years' time. That is the numbers of years. And the interest rate is what? Is 8%. Market value is what? 102. Yes, we have year zero. Year zero will usually be your market value. And what is our market value? Your market value is the current value, which is the current market value of debt is what? 102. 102. Then we have here 1 to 5. So the year 1 to 5, that will represent our interest net of tax. And our interest rate given from this question is 8%. Interest, that is 8%. And we have year 5, which will be our redemption. And we can redeem debt at either par, premium, or discount. So it is not stated here how to redeem this debt. If we are redeeming at par, at premium, or discount. But since we are not given, that means this will be redeemed at par. And the par value of a debt is usually 100. Are we following?
Yes.
All right. Now, the redemption, will be 100. Discount factor, this is a try and error. We have to assume 2 discount factor. The first one will be high, will be lower, the other one will be higher. Irrespective of any discount factor we are using, we are assuming 2 discount factor. One will be lower, the other will be higher. Now, which one do we use first?
Let's use the lower first.
So irrespective, what is the percentage are we using? So we are assuming any figure.
Let's use
We should use what?
5%.
Okay, we are using 5% to start. So year 0 is usually 1. Year 1 to 5, that is annuity table. So at the back of our question paper, the annuity table will usually be given to us. So there won't be any need to go and be calculating our annuity factor. So, but for external sake, we will need to calculate the annuity factor. The formula is 1 minus 1 plus R raised to power minus n. You close your bracket, all this divided by your R. But for us not to waste much of our time, just go to the back of your question paper. You are going to see the annuity table. What you need to do is to go to the annuity table at the rate of 5%, check up to 5 years. What is the factor that we are having on it? Can somebody figure me? Hello, are we there? After this illustration, we are going to call it a day. We complete the rest in our next class. Are we together, please?
Yes.
All right. So what is our discount factor? Year 1 to year 5, annuity, 5%. We don't have an annuity table. Can we make use of our calculator?
Wow, not getting it.
Are we together, please?
Yeah, we are with you. I'm not getting the.
Okay.
I'm trying to calculate.
Let me bring out one annuity table. It will also still be the same annuity table that will be given to us in the examination hall. Or we just check at the back of our formula table or of any of the past question.
Okay.
Can we see my screen now?
Yes.
Annuity. So this is how we are going to determine that. The annuity, just go through the annuity table. Look at the rate at the top. This is 5%. Then we trace this 5% to 5 years. So this is 1, 2, 3, 4, 5. What we are having here is what? 4.329. Can we see that?
Yes.
So if we use calculator, we will still arrive at the same answer. But for exam condition, in order not to waste much of our time computing annuity, just go to the back of your question paper. You will have this table at the back. So just trace it to the rate that we are looking out for. Then how many years? So this is what? 4.329. I hope we are all there.
Yes.
4.329. Then year 5. This will just be our normal discount factor. That will be discount factor, DF. This will be 1 divided by 1 plus R raised to power N. That will now be 1 divided by 1.05 raised to power 5. 1 divided by 1.05 raised to power 5. What will be the value? One divided by 1.05 raised to power 5. Figure me, please.
One divided by
1.05 raised to power 5.
0.7835.
835. That is 84. So present value, your present value will just be your cash flow multiplied by your discount factor. So you do same to the other discount factor and the cash flow. So we've assumed this. Let's sum this together. What will be our net present value? Our NPV here is what? 11.032. So if we are to have negative or a lower NPV, so that means we are going to increase our discount factor. Is that not?
Yes.
Now, what rate can we use? Assumption. Hello?
You can use 10.
We can use 10. Please, irrespective of the discount factor that we are using, either we arrive at positive, your formula will still guide us on what will be our internal rate of return. Whatever we have will not alter our computation. So if we have positive, there is no need of going back to go and be getting one positive and one negative. It is not necessary, irrespective of what we are having. If we can impute that directly or correctly into our formula, we will still arrive at the same answer. I hope we are together. Discount factor year 0 is usually 1. Now, annuity table, 10% for year 5. Let's go back to our annuity. Annuity, this is 10%, year 5. 1, 2, 3, 4, 5. We have 3.791. 3.791. 3.791. Discount factor 1 divided by 1.10 raised to power 5. 1 divided by 1.10 raised to power 5. What do we have? What do we have?
0.6209. 0.6209.
So approximately 621. Now, this will now be equals to our cash flow multiplied by discount factor. We do same to the other years. We have this, then we sum this together for us to have our NPV. Now we're having negative NPV here. Now we've achieved two things. One NPV with lower rate and another NPV with what? Higher rate, discount factor. So from this information, what is our LR? What is our lower rate?
5%.
5% plus NPV lower rate. NPV with lower rate is what?
11,032.
Divided by NPV lower rate, 11.032 minus NPV higher rate. NPV higher rate is what? Minus 9.572. Are we there? So
Yes.
higher rate minus lower rate. Higher rate minus lower rate will now be 10 minus 5. Are we following? So this is where we are now going to change our minus to what? To plus. So this will now be equals to 5 plus 11.032 divided by what? 11.032 plus, because we're having two negative signs. Minus times minus will give us what? Plus 9.572. All these will now be multiplied by what? By 5. So can we compute this? Five plus 11.032 divided by 11.032 plus 9.572 multiplied by 5. What do we have?
Stephen?
I didn't get that. 5 plus 11.032 divided by 20 point this. We have this multiplied by 5. So this will now be 5 plus is 0.53543 multiplied by 5. This gives us 2.67715. Now, 2.6755 IRR will now be equals to
7.677.
67715, or we said 7.7%. Please, is this clear? Is this clear, please?
Yeah, it's clear.
All right. Please permit me to end the class here so that we can relax, study what we have done so far up to this level. Then we continue from convertible debt before we move on to preference shares and weighted average cost of capital. Any questions so far before we make it a day?
I think it will be good for the benefit of some of us if we can repeat the redeemable debt illustration maybe once again after maybe the next class.
Okay, before starting the next class.
Yes, it will be good because you know the formulas, the processes are a little bit longer than that one of irredeemables.
Okay, that is not.
So let me see the last answer on the board, the Excel computation on the Excel sheet.
Okay.
What is the final answer? 7.7.
Yes.
5 plus, okay, 2.05, okay. It's okay, all right.
And this Excel will also be shared immediately after the class now. so that we can still use that to repractice on our own. Any other question?
Good evening, sir.
Okay, good evening.
Good evening. Yes, sir. I earlier suggested, I don't know if there's a way we can, because this Excel, by the time we want to recopy the notes, sometimes we actually don't get the formula. I don't know, because the last tutor that took us, he uses something that makes it very easy, like a notepad. I was
Okay.
actually in this class at the last, at the May diet. And by the time we were actually copying out these notes, the formula were already, because you're using Excel now, all the lines are not showing. So it makes it very, very difficult to come back to it.
To the formula. Okay.
Yes.
That is noted. That is noted. The difference between this system and the system is using is making use of the screen touch system. And I think that is the reason why he could be able to use the notepad on it. So I will try as much as possible to look for other means that we'll be able to make use of the formula that will be very easy to understand. Please, is that clear?
Okay, sir. Okay, sir. Because coming back to this Excel, whatever, by the time you send the notes, it's usually all not, I mean, you can't even understand so many things.
Okay.
Please, sir, if there's any other way we can do it without
we will
using
look
Excel
for
table,
other means that we can deploy.
Exactly.
All right. Any other question?
Thank you, sir.
Any other question?
If the Excel is properly formatted, it can be easily understood before sending it.
Okay. You mean the slide?
Yeah, this Excel now, if you format it properly, it can easily be can be cut, it can come up very well.
Or okay. I also get that too.
And I think it also depends on the person, because the Excel, when you point at it, it will actually give you the formula that was used. So it also depends on the knowledge of the person using the Excel as well. Whichever way you have to.
No, please, let us try to understand each other. It's not that the person can't make use of Excel, but if you look at formula that we are using, let me go back to equity, for instance. Looking at the formula using the cost of equity here, you can see it is a kind of scattered. But for somebody that is not together with us in the class, may not be able to understand how do we get this. But if I want to use it directly here, I can just say DO directly divided by what? By market value like this. But this may not also give us the full picture of how do we do this. If you are not directly inside the class, splitting it by 0.35 divided by. So somebody that is not here with us in the class may not know that this is what is a division. I understand that. Please, do we all understand what she's trying to bring up there?
Yes.
All right.
Thank you, sir. I think you got the whole thing. By the time it's coming out as a note, we will not know where the slash and the division line and everything. We will not know where it is anymore.
I get you. All right.
Thank you, sir.
We'll look for a way around it. Thank you all for your submission, for your contribution. See you in the next class.
Is it still by this time?
Yes.
Hello, sir.
Between 8 to 10. But
so our advice will start earlier, because this other class tomorrow we still have class. Those of us are taking all the 5 courses. It's not easy. You won't have time to
if we can be starting 7 p.m.